Let's be real. You want to achieve financial freedom, but there's a ton of BS out there about investing that might be holding you back. These myths can be paralyzing, making you think investing is only for the Wall Street hotshots, or that you need a Scrooge McDuck vault of cash to even get started. Well, I'm here to tell you that's complete nonsense. Stick with me for the next few minutes, and I'll break down these investing myths, giving you the knowledge and tools to start building real wealth, no matter where you're starting from. This is the biggest load of baloney out there. The idea that you need a massive amount of money to start investing is one of the most persistent myths that keeps people from taking control of their financial future. You know those micro-investing apps you see ads for? They're not just flashy marketing tools designed to get your attention. These apps are revolutionizing the way people think about investing by making it accessible to everyone, regardless of their financial situation. They're not just a marketing gimmick. They let you start investing with literally just your spare change. Imagine this. Every time you buy something, the app rounds up your purchase to the nearest dollar and invests the difference. Over time, those small amounts add up. Think about it. That $5 latte you grab every day could be building your future instead of Starbucks. If you redirected just a portion of your daily spending into investments, you'd be surprised at how quickly it can grow. And real estate? Forget needing hundreds of thousands for a down payment. The traditional route of saving up for years to buy a property isn't the only way to get into the market. Look into house hacking, where you live in one unit and rent out the others to cover your mortgage. This strategy not only helps you get into real estate with less money down, but it also provides a steady stream of income to help pay off your investment. Or explore partnerships where you pool resources with someone else to get your foot in the door. By teaming up with friends, family, or other investors, you can share the costs and risks, making it easier to start investing in larger opportunities. I know people who started with almost nothing and built incredible wealth by being resourceful and starting small. They didn't wait until they had a fortune. They took advantage of the opportunities available to them and grew their investments over time. The key is to take action, even if it feels insignificant at first. Every small step you take towards investing is a step towards building a more secure financial future. Don't let the fear of starting small hold you back. Remember, the biggest oak tree started as a tiny nut. Just like that acorn, your small investments have the potential to grow into something substantial over time. The important thing is to start now, no matter how small your initial investment may be. Educate yourself. There are countless resources available, from books to online courses, that can help you understand the basics of investing. The more you know, the more confident you'll feel about making investment decisions. Set clear financial goals. Knowing what you want to achieve with your investments will help you stay focused and motivated. Whether it's saving for retirement, buying a home, or building an emergency fund, having a goal in mind will guide your investment strategy. Use technology to your advantage. There are numerous apps and tools designed to help you track your investments, analyze your portfolio, and stay informed about market trends. These tools can make investing more manageable and less intimidating. Don't be afraid to seek advice. Talk to friends, family, or financial advisors who have experience with investing. Their insights and experiences can provide valuable guidance and help you avoid common pitfalls. Celebrate your milestones. Every time you reach a financial goal or see your investments grow, take a moment to celebrate your progress. Recognizing your achievements will keep you motivated and remind you of the benefits of investing. Just like planting a tree, investing requires patience and care. It may take time to see significant growth, but with consistent effort and a long-term perspective, your investments can flourish. Start small, stay committed, and watch your financial future grow. So don't let the myth that you need a fortune to start investing hold you back. With the right mindset, resources, and strategies, anyone can begin their investment journey and work towards financial independence. The most important step is to start, no matter how small. Look, I get it. The idea of investing can be intimidating. You might be thinking about all the horror stories you've heard, the market crashes, the people who lost their life savings. It's enough to make anyone hesitate. The stock market can feel like a roller coaster designed by someone who enjoys making people nauseous. The ups and downs, the unpredictability, it can all seem overwhelming. But here's the thing, every roller coaster has its highs and lows, and the key is to stay on the ride long enough to enjoy the view from the top. But here's the thing, not investing is even riskier. Imagine holding on to your cash, thinking it's the safest option. But as time goes by, you notice that your money doesn't stretch as far as it used to. Prices go up, but your savings don't. It's like trying to fill a bucket with a hole in it. Think about it. Inflation is constantly eating away at the value of your money. Every year, the cost of living goes up, and if your money isn't growing, it's effectively shrinking. That $100 you have today might only be worth $90 in a few years. Inflation is like a silent thief, slowly eroding your purchasing power. If you're not growing your money, you're actually losing it. Keeping your money in a savings account might feel safe, but with interest rates often lower than the inflation rate, you're actually losing money in the long run. It's like running on a treadmill. You're moving, but you're not getting anywhere. The key is to understand that risk isn't a one-size-fits-all term. There are different levels of risk, and you can choose investments that match your comfort level. It's not about jumping into the deep end without a life jacket. It's about finding the right balance for you. You can invest in super safe, low-yield options like bonds, which are like the steady, reliable friend who always shows up. Bonds might not offer the highest returns, but they provide stability and a predictable income stream. Or dip your toes into the stock market with index funds that spread your risk across hundreds of companies. Index funds are like a buffet, offering a little bit of everything, so you're not putting all your eggs in one basket. They provide a way to benefit from the overall growth of the market without having to pick individual stocks. Real estate is another great option, providing tangible assets and potential rental income. Investing in property can offer both stability and growth, and it's something you can see and touch. Plus, real estate often appreciates over time, adding to your wealth. The point is, you can tailor your investment strategy to your risk tolerance and financial goals. Whether you're looking for slow and steady growth, or you're ready to take on more risk for potentially higher returns, there's an investment strategy out there for you. It's about finding what works best for your unique situation. Don't let fear paralyze you into inaction. The biggest risk is doing nothing and watching your financial future slip away. Take the time to educate yourself, seek advice from financial professionals, and start small if you need to. The important thing is to take that first step. Investing is a journey, and every journey begins with a single step. So, take a deep breath and start your investment journey today. Your future self will thank you. Seriously, even the so-called experts on CNBC can't consistently predict market movements. They have access to the latest data, sophisticated algorithms, and years of experience, yet they still get it wrong more often than not. The market is influenced by countless variables, from geopolitical events to economic indicators, and even the collective psychology of investors. It's a complex, ever-changing landscape that defies easy prediction. Trying to time the market is like trying to predict when lightning will strike. You might have some idea based on weather patterns, but the exact moment and location are almost impossible to pinpoint. Similarly, you might think you can predict market movements based on trends or news, but the reality is much more chaotic and unpredictable. You might get lucky once or twice, but eventually you'll get fried. Just like standing outside in a storm with a metal rod, trying to catch lightning, attempting to time the market can lead to disastrous results. The risks are high, and the potential for loss is significant. Many investors have lost fortunes trying to outsmart the market, only to find themselves caught in a financial storm they couldn't escape. Instead of playing guessing games, focus on what you can control. Time in the market, not timing the market. The longer you stay invested, the more you can benefit from the market's overall upward trajectory. Historical data shows that, despite short-term volatility, the stock market tends to grow over the long term. By staying invested, you give your money the best chance to grow. Dollar cost averaging is your best friend here. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market's performance. It takes the guesswork out of investing and helps you build your portfolio steadily over time. By consistently investing, you can take advantage of market dips and avoid the pitfalls of trying to time your investments perfectly. This strategy involves investing a fixed amount at regular intervals, regardless of market fluctuations. Whether the market is up or down, you continue to invest the same amount. This disciplined approach helps you avoid the emotional roller coaster of trying to time the market and ensures that you're always putting your money to work. It's like a built-in discount system for your investments. When the market is down, your fixed investment amount buys more shares, effectively giving you a discount. Over time, this can significantly boost your returns as the market recovers and grows. It's a simple yet powerful way to take advantage of market volatility without the stress of trying to predict every move. When the market dips, you buy more shares at a lower price. This means that your investment dollars go further, allowing you to accumulate more shares for the same amount of money. Over time, as the market recovers, these additional shares can contribute to significant growth in your portfolio. When it soars, you benefit from the growth of your existing holdings. The shares you bought at lower prices during market dips will now be worth more, increasing the overall value of your portfolio. This growth can compound over time, leading to substantial wealth accumulation. It's a simple, effective way to build wealth over the long term, without the stress of trying to outsmart Wall Street. By focusing on time in the market rather than timing the market, you can take advantage of the market's natural growth and avoid the pitfalls of short-term speculation. This approach allows you to build a solid financial foundation and achieve your long-term financial goals with greater peace of mind. We've busted 3 major investing myths today, proving that you don't need to be a millionaire to start building wealth. Remember, the most important step is to take action. Start small, diversify your investments, and stay consistent. Time is your greatest ally, so don't waste another minute letting these myths hold you back from achieving your financial goals. Now go out there and start investing in your future